But I know there's.
Okay, yeah.
All right, we're going to go ahead and get started with our next breakout session. So if you can find your seats, that would be wonderful. And bringing it back up to the front, please. Thank you. All right. Now that we're all well fed, we're ready for another session of exciting content. I'm excited to introduce today's next guest presenter, Nancy Tyree from the Department of Revenue, who's going to be sharing with us on state business taxes for ISBDC advisors. So I will turn it over to Nancy.
Excellent. Thank you so much for the introduction. Can everybody hear me? Is this microphone volume okay? I'm seeing nods, so we're going to progress. Yes, as mentioned, my name is Nancy Tyree. I'm the Agency Initiatives Manager with the Indiana Department of Revenue. Our office is actually just like a block that way. So this was a very short trip. Thanks for accommodating us. Also with me today is Daniel Klein. Daniel is a member of our audit team, and he is much more knowledgeable about a lot of this stuff than I am because he works with businesses when we audit them. Therefore, he has a lot of on-the-ground experience, understanding how some of this stuff practically gets applied. So when you inevitably have questions for me, I'm very likely going to be leaning on Daniel to help me with them. But for now, we'll go ahead and get started. If you have questions, feel free to ask throughout. If we start getting a lot, I might ask for them to be held until the end. But we'll hang around for a little while after. So even if you have a question, there's no time to get addressed, just come find us in the hallway. So our legal makes us put this in here. It basically says everything that's here is accurate and up to date to the best of our abilities. But if something changes, please don't assume that guidance is forever accurate. I'm going to tell you at the end of the presentation how you can find up-to-date information on our website so that you are always working with the most accurate guidance that we have. I'm going to talk a little bit about our agency, how businesses should get started when they are going to be starting business in Indiana for the first time. We'll talk a little bit about the most common tax types that they tend to need to know about and file and remit. I'm going to cover remote seller rules, which are a little complicated, but there's something that affect a lot of businesses these days. How to file and pay taxes, and we'll cover some business resources. The first of which is the New and Small Business Owners Handbook. This is meant to go along with the presentations that we give to small businesses. In fact, a few faces in here look familiar. I have in the past worked with some ISBDC hosts who have helped us give a version of this workshop to small businesses in your area. So if any of you are interested in that, just let me know afterwards. We can always schedule something. So to start off with, the Indiana Department of Revenue likes to call itself DOOR. If I refer to it as that, please don't be alarmed. We just really like acronyms. We are the Revenue and Tax Agency for the state of Indiana. We are not the IRS. In fact, it's very odd, I think, how little the IRS and state revenue agencies communicate with one another. They really are very separate entities. We handle different types of income and trust taxes that are collected for the state level, and then help direct that money we collect to other agencies so that the state government can run on the tax dollars that it collects. That being said, business taxes aren't just handled by us. As I just mentioned, the IRS is a separate entity. So if you're ever working with businesses that have federal questions, please do direct them to the IRS. We probably can't answer them. Additionally, state unemployment tax for anybody who has employees, that's handled by the Department of Workforce Development. And property taxes, if you have a brick and mortar store, those are handled by local governments. I like to preface those few things right off the bat, because if you ever have questions about those things, I want you to go to the right place to get them resolved. But now that I've told you what we don't do, I will let you know a little bit about us. We're a large state agency. We have around 700 team members all across the state. A good chunk of them are in that building just across the way, but many of them are located in offices. We have 12 of them throughout the state. So no matter what region you serve, we should have an office somewhat near you. We administer over 65 different tax types. I'm only going to talk about a few of them today. And we really believe that our job is not just to collect taxes, it is to support taxpayers and people like you who also support those businesses who collect and remit taxes. If they know what they are doing and they feel empowered to do it well, that makes our jobs a lot easier. So it's altruistic, but it's also selfish. We don't have to do as much collecting and auditing when businesses are doing things the right way the first time. So we appreciate any help you can give us in making that happen. When a business is deciding it wants to start business in Indiana and it comes to their state tax obligations, there are a few things that we recommend happen in a certain order. Because if a business goes out of order, they're probably going to experience some roadblocks. So first things first, although I'm not going to get into the weeds about it at all, businesses need to have their structure decided before they get registered. Yes, some people do just try to start registering for sales tax without knowing how they are going to structure their business. But this is something that, as you know, determines a lot. It determines the owner's liability exposure, how and when they pay their taxes, how much control over the organization they have. And if a business doesn't settle on this before they get registered with us, they're not going to get very far in the registration process. If a business starts as one structure, it can change how they are structured over the life of their business. It is common for a sole proprietorship to, at some point, become an LLC. When that happens, they often need to re-register with us, but that isn't a rule across the board. For example, a C corporation can become an S corporation pretty easily. They do not usually need to do a lot of re-registration to make that happen. So it just depends. Also, this is something that can be a very complicated decision. And on occasion, businesses contact us when they're getting registered and ask how they should be structured. That is something our customer service team cannot answer, and they don't try to. We actually would often point them back to you or to a professional if they would like to and have the resources to hire a CPA or a lawyer at the outset. Even if they can't hire someone for the life of their business, just someone who can check those things early and make sure they're getting started on the right foot is very important. And for those who don't have the finances to do something like that and hire someone, you fill that gap marvelously because you can at least point them in good directions of other free and low cost resources, even if you're sitting there thinking, I don't know all the logistics of what an LLC entails. So thank you. When it comes to getting registered with the Indiana Department of Revenue, we point people to InBiz. This is technically not our website. It is the Indiana Secretary of State's website. We partner with them and a few other agencies, and a business can go there and get registered with all of them that they need to at once. So that's very convenient. When it comes to registering for your Indiana business taxes through InBiz, you are registering usually for the big four. For small businesses, it's often going to be one or more on this list. There are others that they can apply for on InBiz as well. But as you can see, if they sell a product, they'll need to apply for sales tax. If they have employees, withholding tax. And then in certain jurisdictions, there are taxes called the food and beverage and county innkeeper's tax. I won't get into those today, but if you run a business like those, you'll want to do some more research about those tax types to make sure you're doing them well. And we have special guides on our website for both of those tax types to make sure the people who need to deal with them know what they're supposed to be doing. So when you get registered, as you can tell, pretty much everybody is going to register for sales tax, even if nothing else applies to them. That's just so common for small businesses. While they are registering for sales tax, they are also getting their registered retail merchant certificate, their RRMC. As long as they file everything accordingly when they get registered, they are going to hear back from us with that RRMC and official approval pretty quickly. We send them a welcome letter. They're able at that time to get started on InTime, which I'll talk more about later. And that RRMC is very important because that's what allows them to legally conduct taxable sales in the state of Indiana. If you don't have it when you start out, or if you let it lapse because you are no longer in good standing with us, then technically you can't collect and remit sales tax. It's a legal issue. Most people don't like to be in that situation, so they don't put themselves in it. I did want to mention, every once in a while, we encounter somebody who starts a business and they know they're supposed to collect and remit sales tax. So they collect it and they try to remit it, and then they realize that they haven't gotten registered with us. So they don't know what to do there. There's actually a pretty easy way to do that. First of all, most of them, if it's a small amount, they can just go ahead and get registered and file what they have because they're probably going to be an annual sales tax filer and a due date won't have come up for them yet. But if they have been making sales for a while without remitting, and especially without collecting sales tax when they should, they can go to our website and search for the voluntary disclosure program. That is basically just a way of getting into good standing with us. And because you're doing it voluntarily, we're not going to crack down on the fact that maybe you have a lot of penalties and interest on what you already owe. We want businesses to try to do the right thing with us, even if they didn't realize there were some rules they should be aware of early on. So again, that's the voluntary disclosure program. If you're curious, look for it on our website. It's run by our policy team. They're very nice. All right, so depending on the nature of each business, different owners may need to file several different types of taxes. So no two businesses are going to be exactly the same. I wanted to cover some of the most common tax types though. Right off the bat, we have individual and corporate income taxes. Your individual taxes are what you file every April 15th. Or before that, if you're really on the ball. Hopefully you are all aware of that deadline this year, or have already done it. This is the exact same type of tax return that individuals file, even if they don't have a business at all. Because when you do have a business and you earn income yourself, you still have to report that income on your individual tax return. Additionally, some business owners might be subject to corporate income tax, depending on how their business is structured or if it's registered with the Secretary of State. Sole proprietors generally don't need to worry about corporate income tax because they just report everything on their individual income tax return. But most other business structures, LLC, corporations, etc., they do. So the basic rule behind corporate income tax is you take all your business income, you subtract your business expenses, and you owe taxes on the difference. Very straightforward. No one should ever have a question about that at all, right? Of course, it is more complicated than that. And because it's more complicated than that, we have this wall of text on this slide. This outlines what different businesses have to file in order to meet their individual and corporate income tax obligations. So as you can see, the structure of your business determines which form or forms you're going to need to worry about. And pretty much all of them have to file individual forms. That's the IT-40 and anything else with some letters after the IT-40. And then all the other forms on there, the IT-65, the IT-20, IT-20S, etc., those are in the corporate income tax umbrella. So C corporation files the IT-20, an S corporation files the IT-20S, etc. I like to let businesses know about this when I talk to them at these kind of presentations, because if you go to this page of our website, the tax forms page, you can find all of these forms. And more importantly, you can find the instruction booklets that go with each of them. So if your due date is going to be in April or May or something like that, and that's coming up and you're worried that you don't know what you're going to be expected to provide in your corporate income tax return, you can go to our website, find the forms, find the instruction booklet, and walk through exactly what you would be expected to tell us when it does come time for you to file. And we know most people don't file by paper. They don't print these forms off and mail them in to us. But when you file online, if you use TurboTax or something like that, you're just filing an electronic version of these forms. It's asking the same questions, and it doesn't provide the instruction booklet so that you can really see what we're asking for on those different lines. So encourage businesses to look at these in advance if at all possible. It can be a little overwhelming, but if you really sit down with the tax form and the instruction booklet next to it and just go line by line, it is pretty illuminating about what you're going to be asked to provide. And it helps a lot more than it would for me to just tell people a bunch of information, because they're getting stuff that really applies to them in their specific situations, exactly what they're going to be asked to tell us about when it's their due date. All right, so those were the corporate and individual income taxes. Next up, let's switch gears, talk about trust taxes. That is a term that's weirdly difficult to define, but it's basically when you collect taxes through some kind of mechanism from your employees or from customers. You hold it in trust and then you remit it to us at a later date. So the first big one is sales tax. If a business is engaged in retail sales, they sell goods or tangible personal property, they rent accommodations, they have to register for Indiana's 7% sales tax. Interestingly, services are not taxable in Indiana. What that means is if a business provides a service rather than selling a product, they should not charge sales tax for that service. Now, there are some businesses that exclusively provide a service, a masseuse, a barber, something like that. They might never need to get registered for sales tax in the first place, if that is the case. But it is very common for a business to do both. They provide a service and they offer products. Even if that masseuse sells some body lotion that they use on their clients during the process, that's still a product when they sell it. So they would need to charge sales tax for that and get registered in the first place. A more common example would be something like a mechanic, because if they provide a replacement part for your vehicle and the service of installing it, that's a product and service. They should charge sales tax for the product, not for the service. It's That's why it's very important for them to itemize receipts. That way they're applying sales tax just to the right thing. The customer knows they're doing that. They know they're doing it. And if they ever get audited, we know they're doing it right. Sales tax is filed on a monthly or annual basis. That depends on how much the business is collecting and remitting to determine that. It is decided initially when the business gets registered on In Time. They provide an estimate of what they think they'll be collecting and remitting. We decide if they're monthly or annual based on that. They know that once they have finished registering, and then it can change later on. If it turns out, you know what, actually, you're remitting more or less than we thought, let's change you to monthly or annually. Generally, small businesses start as annual filers. If they grow and expand and are doing more and more business, they may become monthly filers. If that ever happens, we notify them by sending a letter in the mail around December of each year so that the upcoming year, they can switch accordingly. Now, in the state of Indiana, we say that all sales are taxed unless there's a specific exemption. And the law says there's two ways exemptions can happen. One is if something is just exempt according to the law. So someone wrote in the law, these items are always exempt. The things on here are good examples of that. Postage stamps, newspapers, lottery tickets, gift cards. You don't charge sales tax for those. You don't remit it. There are some other examples, though, where exemptions occur if a customer provides an exemption certificate, which I'm going to talk about a little more in the next slide. For now, two things I wanted to point out here that are very common for businesses that are exempt. One is food and food ingredients. The other is items purchased for resale. So when it comes to resale, if a business is purchasing inventory, something maybe they buy from a wholesaler and then they're going to sell later in their store, they can claim an exemption for that. Because in Indiana, we only want to tax that item when it's going to the end user. If it's inventory, they're going to sell it to the end user. That's when tax comes into play. Sales of food, that gets very complicated. Because of that, I'm going to point you to Sales Tax Information Bulletin number 29. The big takeaway is if it's sold by a restaurant or caterer, you probably have to charge sales tax. If it's not, if it's something like in a grocery store, convenience store, it depends on the item. A lot of them are exempt, but not all. That reference document has a great breakdown. So if you work with any restaurants, anybody opening up a grocery store, something like that, please refer them there. They're going to need to know that information. And thankfully, it's something that will not be too troublesome throughout the life of their business. They take the time at the beginning to know which products sales tax must be applied to and which it must not. And then it's a lot easier as they go forward because that information doesn't change too much. Like I said, exemption certificates are very common. So if someone gives a business an exemption certificate, that's their way of saying, hey, I don't have to pay sales tax for this. The most common one is the ST-105. Businesses who receive these should just take a quick look over them, make sure everything looks okay, that it's been completely filled out and signed, and then they keep a record of it. They do not charge sales tax for that specific sale. If they ever get audited by keeping a record of the exemption certificate, our auditors know that they did the right thing in that instance. If they don't keep a copy of it, we don't know that. So we'll probably make them pay that sales tax, even if they didn't collect it from that customer, which is not very fun. While the ST-105 is the most common one, and if you want to find it, it's right there on our website. You can see all of the different things that people can claim exemptions for. It's kind of cool. There is one exception, Form NP1. Nonprofits use that form. They used to use the ST-105, but it was a whole thing. Now they don't anymore. These are the two big forms that businesses might receive to document exemption certificates. They look pretty similar, but just be aware there's more than one of them. Withholding. If you ever work with businesses that are starting off hiring employees, which is fantastic, just be aware they will need to deal with withholding tax. Also, although I don't normally mention this when I talk to businesses, I did feel like it was worth mentioning to you. Withholding tax is required for employees. It's not required for independent contractors. And I think it's a little more likely that a business just starting out is going to hire an independent contractor than a full-time employee. So if they want to know the legal distinction between those two things so that they can make sure that they're following the rules correctly, there is guidance on the IRS website. Go to their website, search for independent contractors. It really breaks down the rules in a lot of good detail. And I think that will help people understand if they're not sure already. But the big takeaway message here, withholding tax needs to be applied to employees, not to independent contractors. So I covered maybe 4 tax types. There are a lot more. And the nice thing is that these are not nearly as common as the ones I just went over, but they might apply to a small business. You just don't know. The names of the taxes are often pretty illuminating. As you can tell, if you do not deal with aviation fuel in your daily business, you're not going to owe the aviation fuel excise tax. It's as simple as that. But some of them are, maybe a little interesting. You can't tell from the title if it would apply to you or not. So point your businesses to the small business handbook that I mentioned earlier. It has a section for each of these tax types, including what it is in the first place, who has to worry about it, how to get registered, what the rates are, how to collect and remit it, etc. If they just browse through that and don't see any other tax types that apply to them, then they're probably in good shape. Remote seller rules. All right, so this is very fun. This is something that really impacts businesses who make website sales. So retail merchants located outside of Indiana have some very specific rules they have to follow when they sell to customers in Indiana. If they make more than $100,000 in sales over basically a 2-year period, then whenever they sell into a customer sell to an Indiana customer after they reach that threshold, they need to register with Indiana to collect and remit Indiana sales tax. And then all of those Indiana customers from then on, they have to apply Indiana sales tax to their purchases and remit that sales tax to us. That can be really odd for a lot of businesses, but many states have put similar things into place like this. That makes it very complicated for small businesses who are running an online store because you don't know who you're selling into and you don't know what all 50 states have in place in terms of rules and their thresholds, etc. And honestly, I don't either. I'm the Indiana Department of Revenue representative. I don't know the rules for the other states. What I can tell you is that there are now a lot of resources out there to help businesses who are trying to navigate this. The one I recommend starting with at the very least is the Streamlined Sales Tax Program, because we and several other states partner with them to provide them information about our rules. If a business decides that it wants to get set up with the Streamlined Sales Tax Governing Board, that organization would then help them keep track of their remote sales when they sell into those other states. And there's also some businesses that qualify for free sales tax calculation and reporting services through that program. There are some businesses that pay. I do not know, unfortunately, the qualifications of who gets it for free and who doesn't, but I'd highly recommend any businesses that are worried about this, check out that website. If nothing else, you can at least get an idea because they have a good area of their website where they track all the basic rules for different states. At least that would give them an idea of what some things they should be keeping in consideration are. Yeah, question.
So Streamlined Sales Tax, do they cover all states as far as helping them with that for all states? I thought it wasn't all.
Wasn't all states?
Yeah.
Actually don't know, Daniel.
It's not all states.
It's not all states, yeah. So it's not going to cover everything, but it does have the majority of the states that there are some states that don't have any remote seller rules at all. So they're not going to be covered by this because they don't. There's nothing you need to worry about when selling into them, at least not when it comes to that. So you do cover, I think, a good portion of the states that have rules, but you're right, it's not 100% guaranteed. Question there.
Do we have any, regulations around when someone comes into the state for like a trade show?
Yeah, Daniel, do you want to talk about that a little bit? I could try, but.
Yeah, and they're gonna owe sales tax on sales they make in the state. They've established nexus by conducting business in the state and traveling to the state themselves, so they're going to have to collect and pay sales tax for those sales.
Got it, okay, so that's, we consider that physical presence.
Yes.
Yes.
Got it, okay.
Yeah, all of those remote seller rules, I kind of skipped over this, that we talked about earlier are based on the ideas of businesses that do not have a physical presence within that given state, but still do business there. So yes, if you have a trade show or an art show or something where you travel to a new state, you are establishing a physical presence essentially. I think there are some nuances depending on how, but it
It's
gets
tricky when you
complicated.
get a car dealership that wants to travel across state lines, but use a third-party courier to do it, conduct it.
Yeah.
So there's a couple court cases on it, but in general, just if you're using a third-party courier, you're a remote seller.
Yeah.
But if you're there doing it yourself, or if you're the one driving it in, you've established nexus.
Okay, so if you, never mind, how am I gonna get in the closing?
There's a lot of weeds on this
Yeah.
subject.
Oh, yes, one more question.
Is there, I know that there's a question on the registration that asks for that, like, are you, doing trade and festivals and things like that? So at that point, if it's gonna be a one-off situation, are they still filing the exact same, I mean, or, again, it'll be an annual filing, I'm sure. But if they know they're only gonna come to that festival once, then is there a process then, is it recommended for them to close their account afterwards? Like they just go and make that one payment? Like, so that they don't forget to go in at zero next year, or,
I am not aware of the administrative processes.
okay.
There is a
But
method,
they're
by-
basically still registering the exact same is my question, right?
I believe so. There is a method by which you can close a sales tax account if you are no longer regularly collecting and remitting sales
I just
tax.
had never had
So,
to check that button to know if like, then they have different requirements because all they were doing was like festivals.
It might default them into an annual filing where like a zero doesn't create a red flag, you know, so they're not here all the time, but we don't expect them to completely disappear.
Yeah.
So.
yeah.
They're not doing something. Okay, thank you.
Good questions. If you want to do more digging about this topic, we have an area of our website about remote sellers. It links to more information bulletins. And if you really have complicated questions you want answered, I will refer you to our policy team, who would be happy to talk your head off about all of this. One other sticky detail regarding online sales, but also any sales made across state lines, is marketplace facilitators. So around the same time those remote seller rules were put into place, these were as well. A marketplace facilitator is a person or business who owns, operates, or otherwise controls a marketplace and facilitates a retail transaction. That definition means nothing, at least to me, on its face. Our policy team would hate it if I said that. So I will give you an example. Amazon, Etsy, these are marketplace facilitators. If a business only uses Amazon or Etsy or something like that to conduct their sales online, they don't need to worry about anything we just talked about because Amazon and Etsy are marketplace facilitators. They handle all of that business on behalf of the businesses that work with them. They are better equipped to do it. They are not going to mess up as much as small businesses. So we put them in charge of it. Now, businesses should still keep track of those sales that they're making. When they remit their taxes, they will have a place on the online form or form if they're filing by paper, where they can say these were sales made by a marketplace facilitator on my behalf. That way we know what sales were made by them, what sales were made by the marketplace facilitator. If we needed to, we could cross-reference them. Question?
So if somebody is using strictly a marketplace facilitator, they're not doing the in-person sale in Indiana, but they want to be able to purchase their things wholesale, do they still apply for a registered retail merchant certificate to get that ability, even though the taxes are being handled by marketplace?
If you're a business, you have to have a registered retail merchant certificate. regardless. So it's not, there's no qualifiers for that. If you want to be a business, you gotta get your RRMC.
Okay.
Yeah.
You would, in that instance, they would be filing a lot of $0 returns.
Yes.
So that's what, okay.
They still have to register for sales tax too, so those are two separate things.
Yeah.
Registering for your registered retail merchant certificate and then registering for sales tax are different. And if you're only using a marketplace facilitator, your returns will be very simple because they'll be all excluded sales. That's the category.
Sales, thank you.
Yeah. Not exempted sales, they'll be excluded sales, so.
And getting an RRMC and applying for sales tax, those are two different processes. I lump them together because if you use InBiz to get registered, you're doing the same, you're doing it all together on the website. So functionally, spelling them out as different processes could just be confusing, but Danielle is correct. I just simplified it. Yeah.
Are tax documents that clients fill out, are they saved in the InBiz account portal or dashboard? So they can access that?
Could you repeat the first part, what is saved on InBiz you're asking?
Yeah, so like, I know like Secretary of State documents are, but like, are any of the state tax documents for you also?
I would assume that a record of their RRMC is there, as well as the information they applied with. But ongoing sales tax filings are not going to be on InBiz. I'll show you where those are in just a little bit. One other thing before I move on from marketplace facilitators, a lot of small businesses use platforms like Shopify, which sound like marketplace facilitators, but technically are not. Shopify helps sellers keep track of where sales are coming from so that sellers can apply the correct sales tax rate and get registered when they need to, but it doesn't do it for them. It just helps them do it themselves. So if businesses use a platform and they think, yeah, it's a marketplace facilitator, I'm all set, maybe double check. That might be the kind of thing they have to call a customer service number and ask, hey, who's in charge of the sales tax remittance? Is it me or you? They'll tell you that, don't worry. When it comes to filing and paying, I wanted to give you just a little bit of information about how this works. As discussed earlier, some people file annually, some monthly when it comes to their individual incorporated, or when it comes to sales and withholding tax. Also, corporate income taxes have different due dates depending on the form. And then finally, some businesses are fiscal year filers instead of calendar year filers. I honestly don't know anything about that, but it does change their due dates. Because of that, I always point people to the tax filing deadlines page if they want to know when something is due, because they can just look that up. And that's easier than me memorizing a bunch of dates. Also, like I said, that tax status, monthly or annual for their trust taxes, can change. I already talked about how that works. Good for me. Already finished that one. $0 returns. Let's talk about that. Businesses are required to file and remit every period. So if they are a monthly filer, they have to file every period. Now, it's really common for a small business. Maybe it's seasonal. So they're going to close for a month or two. Maybe they have to temporarily close because the owner is dealing with a health issue and they are a one-person operation. No one else can step in. Maybe they get registered, they're really gung-ho and they do it well before they ever actually make any sales. Therefore, they have several months or even a full year where they don't collect any sales tax. In all of those instances, if a due date is coming up, they still have to file. They will probably file a $0 return because they have no sales tax owed. But by filing, sending it in and telling us that they don't owe anything, they're fulfilling their obligation. If they instead just ignore that window and do nothing, we don't assume that they had nothing to remit. We assume they forgot, and we might send them an estimated bill, which is not fun for them. To remit sales online, or to remit sales and withholding tax, you usually need to do it online. We recommend using our website, InTime. This is our official portal for filing, paying, and managing taxes. There are a lot of things you can do on InTime, not just file and pay sales tax. You can view historical records of what you've remitted to us in the past. You can have online correspondence with us. If we send you a letter in the mail, you can see a PDF copy of that letter on InTime. So when letters get lost, as they often do, there is a record of that. A new business must be registered with InBiz or in some other way registered with us before they can create the In-Time user log on. So once they get that welcome letter after we've approved everything, after they've registered, they can use the letter ID in there to set up their In-Time account. I also wanted to point out this area in the second bullet point, guides. In-Time is an interesting portal because there's so much you can do on it, but it doesn't exactly tell you how to use it. So instead, on our website, the DOR website, we have an area where we store all of our In-Time guides and resources. If someone's setting up an account or performing some action for the first time on In-Time, let them know there is probably a guide for it. They can find it on our website, pull it up, and just go through the steps as the guide outlines. That is going to answer 9 out of 10 questions that people have. But unfortunately, because it's not on the In-Time homepage, sometimes people don't know about that. And I can't do anything about that. I don't work with the ITS people who oversee In-Time. So I wanted to let you know about it. All right. This is pretty much every tax type that is available to file and remit on In-Time. Please do encourage the businesses you work with to set up In-Time accounts. They don't have to use In-Time. There are third-party providers like ADP or QuickBooks that allow a business who uses them to remit their taxes federally and to whatever states they work with. I don't know how much those cost. They can also hire a tax professional. I don't know how much that costs either. In-Time is free. The only reason you are going to be spending money on In-Time is if you pay by a credit card. If you make bank account payments, there is no service charge associated with that. And you're working directly with us instead of through a third party. So there's less of a chance of a game of telephone ending not in your favor, I think. It really is a good resource for small businesses doing their own taxes. So I've mentioned the importance of meeting deadlines, paying those or filing those $0 returns, even if you have nothing to remit. And that is because when a business fails to meet those deadlines, they enter our collections process. Now, the early stages of the process are, I'm going to categorize as annoying, but not debilitating. You're probably going to owe penalties and interest. You're going to get some letters in the mail from us. You're going to freak out. But if you respond to those and you handle whatever the penalties and interest are, maybe you need to get set up on a payment plan. Maybe if there was a very good reason you've missed a deadline, you can request an abatement of the penalty. Then you can get it settled, right? If you get that letter from the mail if you get that letter from us in the mail that says, hey, you missed your deadline, and you don't respond to it, then we send you another letter that says, hey, you missed the deadline. Here's what we think you owe. That's the estimated bill. If you don't respond to that, then we send you another letter that says, hey, here's what we think you owe. You no longer have the right to appeal. Please pay this within 20 days. If you don't respond to that, then we send you a collection agency referral, or if you're referred for a tax warrant, credit scores could get affected. RRNCs, the next time they are up for renewal, won't be renewed. These are
also just get revoked.
They get revoked, yeah. I'm putting it really in the passive voice. They don't get renewed, they get revoked.
Yes, I can go in and actively revoke your business's RMC.
Yeah.
It's fine.
It is not a good situation. So please encourage any businesses that are in business already and maybe receive a scary letter in the mail from us. It is better for them to respond promptly and just try to work with us. That at least is going to keep them from those later stages, no matter what it is that they eventually have to end up doing. And we encourage people to do that. People often ask us about what records they should keep. There is a lot of information in the handbook for each tax type about what kind of records we advise people to keep. Those are the records that if your business was ever audited, our auditor would ask for copies of those. So check those out. And the rule of thumb is keep records at least 3 years from the date of the last filed return. That is how far back audits typically go. There are some exceptions, but those are usually for businesses not filing at all, which hopefully shouldn't apply to any businesses you're working with. That is the rule of thumb that will keep people in good, safe condition. All right, and before we wrap up, I wanted to give you some resources. So I already mentioned the handbook, link into it again. You can't stop me. These first 2 bullet points, though, these are new. The first is the tax library. If you go there and search for information bulletins, there will be a tab that says information bulletins. Just peruse those. There's dozens. They're categorized as sales, income, and general information bulletins. They cover so many topics. Some of them are about specific tax types. Some of them are about specific business industries. Like we have one for auctioneers, we have one for manufacturers, we have one for restaurants. They cover so much. Just looking through there and seeing if there's anything that applies to a given business is usually going to be a great starting point for that business to research what kind of things they need to worry about. And if they have questions down the line, starting there is also a good thing to do because these are vetted and created in the first place by our legal team. They are official guidance documents. They're as close as you can get from actually asking the policy team to make a ruling, which you probably don't want to do because that's quite a process. The business tax page, that is where you can find a lot of good stuff, county tax rates, forms, and also an FAQ page. I can't say it's comprehensive, nothing possibly could be, but it is a darn good starting point, and it's probably a little more, let's say, accessible than the information bulletins. Those are dense. They're written by the legal team, so you can imagine, but they are good. The FAQs are written in a little more plain English, let's put it that way. If anything changes down the line, you can subscribe to get email updates from us. Go to the contact us page of our website, click on the box that says sign up for door agency announcements, enter your email address. There's lots of categories. I'd suggest the tax bulletin. That's our monthly electronic newsletter. There's lots of ways to get in touch with us. Our phone number, if you have an InTime account, you can send us an InTime message. There's a way to send a general message. Go to the message section. And there's something called "This message doesn't concern a specific individual or business." You can select that and type your message. And also you can see us in person at any of the district offices located near you. You can schedule an appointment in advance. I ran right up to the timeline. Go back so you can write that down, of course. So you'll have to imagine the thank you screen here. But thank you all so much. Daniel and I will hang around for at least a little while more in case there are additional questions. And thank you all for all the good work you do with Indiana businesses. I hope this has been helpful.
Nancy, hopefully it was exciting and you learned a lot.
Taxes.
Taxes. All right, well, we are, like you said, right on time. We have 15 minutes before we need to be across the hall in the auditorium for the network awards. So take this 15 minutes. Feel free to ask any follow-up questions of our presenters, restroom breaks, etc. We're going to try and start promptly at 2, so please do make your way over there. Thanks, everyone.
Go for it.
Stay right here.
It's meant to be.